Hello, we are Team Enigma, and my teammates are Chris, Josh, Steven, and Patrick, and my name is Rodan. Firstly, with the agenda today, we're going to be talking about key metrics, the market, chosen strategy, closest competition, implementation of our chosen strategy, and reflections on the company's overall performance. Starting off with the key metrics on net revenue, our lowest for net revenue was $195 million, and our high was $399 million. For earnings per share, our low was negative 0.20 and our high was 5.77. With return on equity, our low was negative 1.4% and our high was 24.7%. With stock price, our highest prices were $65 and our low was $15. Moving on with the credit rating, the lowest credit rating we've ever received throughout the simulation was with a C+, and an A was our high for the credit rating. And image rating with our low at 63, and the highest for our image rating for our company was at an 80.
And this is Josh talking to you about the market. First, what we're going to do is look at North America, and we're going to take a look at both of the product markets. First, we're going to look at the entry-level market. We're going to see that price, quality, advertising, and tech support. For price, it's going to be more of an important issue. Quality, it's less of an importance. Advertising and tech support are both important. And in the multi-feature market, price, quality, and advertising are more important, and tech support is less important. In Europe and Africa, we see that price is more important, and quality is less important. Advertising is more important, and tech support is less important. And the multi-feature is just about opposite. And the reason they have that is because the entry-level market is more persuaded by price, and the multi-feature market is more persuaded by quality and tech support. For Asia Pacific, we can see that price is important in both of the markets. Quality and advertising are not important, and the tech support is most important. In Latin America, we can see a shift of price, variation of importance. In the entry level, it's more important. In multi-feature, it's less important. And for the rest of the three, quality, advertising, and tech support are less important, and the multi-features show that quality is important, tech support is important, and advertising is less important. We take a quick overview of the global concern for entry-level cameras. We see that 50% of the customers that are purchasing those cameras are concerned with price, and tech support and advertising would be secondary factors of purchasing. In the multi-function cameras, we can see that quality is the most important, tech support would be the second important, and price and advertising would be the third and fourth important. And what we did for the trends is we took a look at the averages of which were trending upwards and downwards. So you can just kind of take a look here and see that tech support, advertising, those are all upward trending features of the market in North America. You can see in Europe and Africa, a lot of them are trending upwards. In all of these various trending markets, you can see that price is typically going down, and tech support and price and those types of value added features are going up. And you're going to see about the same thing in Latin America. And so now we're going to move on to the chosen strategy of what we chose to do for Enigma.
So while we talk about strategy, I'm also going to cover the competition. Now again, we are Team Enigma, and we competed directly with Heritage Corporation as well as Digitech Corporation. You'll notice at the beginning of the simulation that all three companies started off on about equal footing. But over time, Digitech started to take the lead, while Heritage and Enigma both suffered losses. Ultimately, we were able to change our strategy and recover, sending Heritage down and also beating out Digitech. So let's talk a little bit about strategy and what our competitors were doing. Heritage's strategy was very middle of the road. They wanted to put out a mid-tier product at a mid-tier price, mediocre ratings. Digitech wanted to be the cost leader. They kept their costs extremely low, and as a result, they could sell it at the lowest price possible. Enigma's strategy was the value leader, so we wanted to put out a high-quality camera, but also offer it at a low price. You'll see that regardless of low-end or high-end camera, Digitech was always the cheapest, Heritage was the most expensive, and Enigma was in between the two. Now, what we found over time is that as a result, Heritage was never really able to gain a ton of market share. Digitech, with their low-cost, low-price product, was able to get market share, especially in the high end. But because we produced the best quality camera, we got the best market share. For every dollar that we received in revenue in year 8, about 75 cents of that dollar went to production costs. We made a conscious effort over time to reduce our production costs, as did Digitech. Ultimately, in year 14, we got our production costs below 60 cents, as well as Digitech got theirs below 55 cents. And unfortunately, Heritage was really never able to recover and get their production costs lower. Ultimately, what we found is that Digitech had a very good strategy of being the cost leader. They wanted that low-cost product as well as a low price. But before we get too deep, we're going to also recap years 10 and 12.
Before we jump into our strategy for year 13 through 15, I want to briefly recap where we were in years 10 through 12. If you recall from our last board meeting, these years marked a low point for Enigma, with record low revenues, negative return on equity and earnings per share, and we failed to meet a single one of our shareholders' expectations. A quick look at our performance charts and you could clearly see the downward trend. Change was obviously needed. To turn the company around, we devised a 4-point strategy. The strategy focused on increasing market share, cutting costs, and continuing with our stock buyback program, and ultimately improving our credit rating. We felt if we could improve in these 4 areas, we would meet our shareholders' expectations and become competitive in the market. Because our production costs were relatively high when compared to the competition, it was imperative that we increase our volume of sales and reduce our costs. We noticed that the entry-level market was highly sensitive to fluctuations in price, so to gain market share, we lowered the price point on our entry-level cameras by 20%. We then expanded all of our marketing promotions in both length and quantity, which proved to give our multi-feature camera line a significant boost in sales. Finally, we upped our advertising expenses across the board, focusing on regions where we had historically low sales. With high production costs and our newly lower selling prices, our next priority was to cut costs wherever possible. On our entry-level camera, we dropped the PQ rating from 2 stars down to 1. We then reduced brand-specific components and specialty utility features on both camera lines and saw a savings of $18 per camera on the entry level and $20 per camera on the multi-feature line. In addition, we cut R&D spending significantly. The third piece of our strategy revolved around our stock buyback program. Each year we bought back the maximum amount of shares allowed, which resulted in fewer outstanding shares on the market. This increased our earnings per share and reduced stockholder equity in the company, which in turn boosted our return on equity. And finally, paying down our debt allowed us to lower our debt-to-equity ratio, as well as our debt payback period, which when coupled with our newly increased net revenues, brought our credit rating back into favorable standing. And now Chris is going to take over.
I'll be discussing what went wrong with our organization. To begin with, we had a lack of consistent strategy. We started the game off with the idea of creating a high-quality camera at a very competitive price. Going into the second year of the simulation, we immediately changed our strategy without thinking to simply holding off the competition and driving them back out of our market share. Within a few years, we found that we had completely abandoned our strategy and were simply reacting to the market leaders, which put us into a situation where we were dealing with what they did last year, never giving them or never directly attacking them, which allowed them to continue to dominate. Eventually, we moved into taking a low-price approach. When we did this, we had a significant problem. While we did gain market share, we didn't gain as much as expected because we simply didn't have enough production to handle the demand. So the following year, we increased our production to accommodate this demand. We found that the inflated cost of the production put us into a situation where we weren't making anywhere near as much profit as we'd planned. So, in order to prevent selling out year after year, we also then decided to maintain an excessive workforce to prevent selling out. This caused those ballooning costs to follow through year after year. In year 9, we found that we were 25% higher in costs than the average for the entry level and 30% for the multifunction. In year 10, we were 30% higher costs than average in entry level and a whopping 40% in the multifunction. We then chose to have a market-leading warranty. This was a great idea, except for the fact that the quality of our camera didn't support this, and so we just ended up with massive warranty claims. Our final mistake was that we oversimplified the simulation. There was a year where we turned around and recognized that the marketing leaders in each region were also the market leaders. So we chose to over-advertise in all of those areas. What we didn't do is we didn't apply all the information that we had learned from previous years into that same year so that we can have a positive year. What went right? Eventually, we realized that we were making mistakes year after year. We took all the information that we had gained from the simulation up to that point and applied it all in a single year, avoiding the pitfalls of focusing on just one region. This significantly gained market share. We increased our stock price from a low of $15 to $65 a share, increased investor expectation from a score of 35 in year 11 to 114 in year 15. Significantly increased our rating. What we would do differently. To begin with, we'd set a corporate strategy and stick to it, only modifying it when necessary to meet changing markets. Also, we would investigate the complex systems active within the simulation to validate the interrelated ties linked to each decision so that as we made a modification of one segment of the game, we'd know how it affected the other portions of the game. Finally, we would take a big picture view of the market instead of focusing on just a single section per year. Lessons learned. To begin with, choose a strategy and stick with it. Next, don't lose sight of your core competencies. And finally, investigate why specific decisions affect other portions of the simulation. In conclusion, Enigma Corporation almost failed because we made reasonable decisions to modify individual aspects of our company, yet did not incorporate them into a single unified strategy. We only righted course after we began merging all these individual decisions into a single strategy and applying them year after year. Thank you very much for your time. Are there any questions?